You are watching Market Pulse Daily. Today is Tuesday, May 26, 2026. If you want a clean daily read on macro and market risk, subscribe for the next briefing. Markets are betting on peace and lower rates, sending Bitcoin soaring. Today's agenda: Federal Reserve pivot and debt constraints, geopolitical de-escalation, Bitcoin's bullish outlook, market reactions and risks, crypto deep dive. Let's start with the big picture. What's happening with the Federal Reserve? Federal Reserve held its benchmark interest rate steady at 3.6% in its last meeting. But the real story here is the growing pressure from U.S. government debt. Interest payments on that debt have doubled since 2022. This makes it incredibly difficult for the Federal Reserve to keep raising rates. It's a structural constraint. Unlike 2022, when they could hike aggressively to fight inflation, today's situation is different. The Federal Reserve's hands are tied by the sheer cost of servicing its debt. Markets are already reacting to this. Bond yields are showing signs of easing from recent highs. This signals that traders are anticipating rate cuts, not more hikes. This anticipation is a major reason for the current risk-on mood in the markets. For the week ahead, pay close attention to labor data and consumer confidence. Any weakness there could speed up these pivot expectations. And of course, listen to what Federal Reserve speakers are saying for any hints about their future plans. As always, keep an eye on gold and silver as traditional safe haven assets, and on Bitcoin as a faster-moving indicator of liquidity conditions and risk appetite. Beyond the Federal Reserve, global stability is also on investors' minds. Despite recent U.S. strikes against Iranian targets and ongoing hostilities, the market is showing remarkable resilience. Equity futures are holding steady. Traders are actively discounting these geopolitical tensions, anticipating potential peace deals. This is a striking divergence between the news headlines and how the market is actually behaving. What this tells us is that investors are increasingly looking past short-term conflicts. They're focusing instead on the potential for long-term diplomatic resolutions. The market's willingness to price in peace means that the risk premium associated with geopolitical uncertainty is shrinking. This frees up capital that can then flow into other assets. We're seeing Brent crude futures show some pressure, reflecting this optimism that tensions might de-escalate. This is a big change from previous times, when similar events would have sent oil prices soaring. The market is clearly betting on a diplomatic outcome. For the week ahead, it's crucial to monitor the Middle East situation very closely. Any sudden escalation could quickly derail these peace hopes and bring back significant market volatility. Watch for any official statements from the nations involved and any updates on reported peace talks. The dollar remains a key variable here. A stronger dollar tends to compress commodity prices and weigh on emerging market assets, while a weaker dollar does the opposite. Now let's talk about the asset that's really capturing attention: Bitcoin. Bitcoin is positioned for a significant medium-term re-rating. The main headwind, Federal Reserve tightening, is being removed thanks to those fiscal constraints we just discussed. At the same time, geopolitical tensions are being discounted by traders who are anticipating peace deals. This creates a highly favorable environment for Bitcoin. It's further bolstered by institutional validation, especially through sovereign investment. We're also seeing a shift towards high-quality treasury models. This isn't just about short-term price action, it's a structural evolution. The market is moving away from purely speculative entities towards profitable treasury operators. And get this, potential sovereign equity stakes in companies like MicroStrategy signal a profound shift. It's moving from regulatory scrutiny to strategic adoption. This reinforces Bitcoin's legitimacy as a national asset class. While Bitcoin saw a slight dip today, the underlying sentiment remains strongly bullish. The anticipation of Federal Reserve rate cuts and geopolitical calm typically drives liquidity into Bitcoin and other risk assets. The asset class is gaining legitimacy, suggesting a resilient floor for price action. For the week ahead, look for opportunities to accumulate Bitcoin during any mid-cycle drawdowns. The sector is consolidating, favoring companies with profitable operating businesses that can fund Bitcoin accumulation without over-leverage. Keep an eye on any news regarding sovereign investment. Let's broaden our view to how other markets are reacting. Markets were closed yesterday for the Memorial Day holiday, and trading is resuming today. In the background, we've got some important data. Inflation numbers for April showed headline CPI at 3.8%. Energy prices in particular saw a significant surge. This is a reminder that price stability is not fully secured, and it could influence the Federal Reserve's future decisions. Meanwhile, the European Central Bank held an emergency meeting. They're addressing cybersecurity risks that have been exposed by AI systems. This highlights a new frontier of risk in our financial infrastructure, a concern that could have broader implications for tech and financial stocks. With markets reopening, we expect some initial volatility. Traders will be digesting the latest economic data and geopolitical updates. The S&P 500 and Nasdaq are resuming normal trading hours. While the overall sentiment is bullish, those underlying inflation and new tech risks could temper any aggressive rallies. We're seeing gold and silver experience some short-term weakness today. This is attributed to profit-taking after recent gains, even though there's still long-term demand for these safe havens. For the week ahead, key events to watch include ADP employment data and consumer confidence reports. These will be crucial for assessing the health of the labor market and its impact on Federal Reserve policy. Also, keep an eye on any follow-up from the ECB's emergency meeting on cybersecurity. Finally, let's dive into the crypto markets. The cryptocurrency market is currently in a fear territory. The Fear and Greed Index is sitting at 34 out of 100. Major cryptocurrencies like Bitcoin and Ethereum are seeing slight declines today. However, Bitcoin continues to hold strong dominance above 5.8%. This indicates a defensive positioning within the crypto space. Despite the current price weakness, trading volumes have actually increased. This suggests some renewed activity, even though sentiment is cautious. Now, this fear sentiment often presents opportunities for savvy investors. The sustained institutional inflows into Bitcoin ETFs are a critical signal. We saw one session and may record over $500 million in net inflows. This suggests that smart money is actively accumulating Bitcoin during these dips. It's building a stronger floor for the asset. Major cryptocurrencies are down slightly today, with altcoins like Solana underperforming Bitcoin. This coordinated selling pressure is typical in a fear-driven environment. However, Bitcoin's stability near about $76,000 despite the broader market fear points to underlying strength and resilience. The increase in trading volume indicates that while sentiment is cautious, there's active participation. For the week ahead, keep a close eye on those institutional inflows into Bitcoin ETFs. Continued strong inflows, even amidst fear, will be a key indicator of smart money accumulation. Also, monitor Treasury yield movements above 4.5% and any Federal Reserve speaking activity, as these macro factors heavily influence crypto. Today, we're seeing markets price in a calmer geopolitical landscape and a Federal Reserve potentially shifting gears due to mounting debt. This optimism is fueling a risk-on sentiment, with Bitcoin standing out as a key beneficiary. While risks remain, the current environment suggests a strong medium-term outlook for digital assets. Thank you for your attention, and we will see you again tomorrow.